Welcome back to Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Today, we are going to talk straight about the USDA report, the newest report, and a very interesting analysis about the competitiveness of the US soybean farmer versus the Brazilian soybean farmer. And all of that is with our guest, Mike Zuzolo. Mike, how are you?
Doing well, Luis. How are you doing?
I'm doing great. Mike, first we should hear your perspective about the USDA report. How did that sound for you? Was that according to your expectations?
Yes, I think on the demand side, it was very close to my expectations from a standpoint that when we talked last, Luis, we talked about the summer grilling season and the summer driving season being very important to holding on to the commodity demand here in the United States. And the Department of Energy had released some data earlier in the week before the USDA report, and it seemed as though the USDA did follow along with that. In other words, they did not cut more than 100 million bushels from the ethanol demand for the current marketing year, and they actually brought back ethanol demand to about 5.2 billion bushels for the marketing year 2020, 2021. And so in the energy sector, we've got a couple, three different big analysts or government agencies, the USDA, the Department of Energy, and even OPEC in their updated monthly report this week as well, all thinking maybe more like a V-shaped recovery when it comes to the global demand for energies. It was especially nice after the USDA report to see the following day energy data on ethanol show a third week of declines, even though production is now about 14% more than what it was on its low from a couple, 3 weeks ago. So we have stocks of ethanol back down at mid-March levels, even though production is coming back online. So it shows that profitability on the ethanol sector is coming back rather quickly. And I've heard at least 3 or 4 ethanol plants starting up again now or starting up again next week. And so that's helping as well validate some of these demand issues. And so
Yes.
from a demand perspective with both the energy and the livestock sector, USDA gave me what I wanted with the idea that we're not losing or seeing too much demand destruction on feed grains. What they did not give me was a wheat number that I could work with. They gave us a very large world wheat number, 310 million metric tons for the new crop year. And that was about, I believe, 15 million tons more than where we were 2 years ago. And I actually think we should be closer to a 280 million metric ton carryover for the world wheat supply demand for 2021, which is where we were back in 2018, 2019 marketing year. But USDA is well above that, and the trade really didn't like that, and we've seen the wheat decline since the report.
And the crude oil seems to be tuned with those numbers, right?
Yes, the demand destruction is not as bad in the crude oil. In fact, OPEC came in this week and said we are cutting our global demand for oil a little bit more than the prior month, about 2.2 million barrels a day. But we're still talking about 90 to 91 million barrels a day of demand compared to 100 million barrels a day back in 2019.
Yeah, and what would be the worst point for wheat in your view?
Well, really, with the May expiration on Thursday of this week for the Chicago Mercantile Exchange futures, and the fact that the July is now lead month, I would like to see the July rally up to where the May went off the board and essentially put a low in right here, right now, Luis. I am surprised by the trade accepting the USDA numbers so easily. In a way I am, and in a way I'm not. I mean, when you live in the state that's the #1 hard red wheat producer, and you see that the very poor to poor conditions on the USDA crop report at 14% compares to 8% last year. And you also see that we are in this state and in Texas and in Oklahoma seeing a significantly higher level of drought in our crop areas on the drought monitor versus last year, where all three of the states that I mentioned were essentially zero at this time last year. I think it's really surprising in a way that the trade would just automatically take those USDA numbers at face value. We're not out of the woods in the Baltic region. We're not out of the woods in the EU when it comes to getting a better crop stand. And Australia is also starting to see some drought as well. But yet the USDA numbers are being taken pretty much at face value. So technically speaking, to answer your question, I would like us to stop going down pretty much right now and have the dollar stop going up. That new 3-week high in the US dollar this week is not helping the wheat market here in the United States.
Yeah, and that's where I'm going to ask you right now. I checked some very stunning numbers for the Brazilian competitiveness. So I saw that from last year to this year, in terms of the Brazilian currency, the real, the profits for soybeans increased by 187%, for corn 235%, both in the state of Paraná. In the state of Mato Grosso, there was an increase of 37.3% for soybeans and 280% for corn. How to analyze all of this? Because are very impressive numbers.
Yeah, I mean, this is where I think when you don't, when you look at the commodity markets and if you don't look at the currency exchange rates in today's world, you're really going to miss a lot, because this really comes into not just the import export side of the equation as far as our value of our soybeans and corn versus your value of soybeans and corn at the ports. It's just as important that the value of the cost of production, because of the different currencies, gives South America and has given South America an extreme competitive edge for the better part of 3 years.
Yeah.
And that's in large part due to almost all currencies. And that's why South America continues to expand their surface area. You know, if we wouldn't have had a 4 or 5% increase in soy area in some of the areas of Brazil and to a lesser degree Argentina, the crop size would be much smaller because the weather was not that good this year. And that's directly related to the currency. So for up here right now, Luis, I can tell you that from what I look at every year and also from what clients are telling me, you go to a place like Central Iowa and try and plant beans, given their high cash rents, even with their fertility, you're still in a loss situation. And, you know, your break-even level in a wide area of the United States is probably close to $8 a bushel. And it can get as high as $9 a bushel if you're talking about irrigated ground that's in central Nebraska. So you really have to perform well on your soybean yields to justify that. That's why I think the corn acreage base here has remained so elevated the last couple of years. But with that having been said, I do think that we are losing corn acres here in the United States because the soybean price, cash market wise, is still better than what the corn price is. And plus, the weather is probably not as conducive to the corn as what it is the beans in some of the northern tier states. One of the exceptions that maybe puts us more on par with South America cost of production is when you get up into the Dakotas. Cash rents are not as high, land prices are not as high, especially if you get away from the shale area in North Dakota, you know, like South Dakota. Cotton states like Mississippi and Louisiana and Arkansas, those are states that have lower cash rents typically, and they can compete more with South America and the cost of production.
Yeah, there is a very large advantage, mostly for Brazil, not so much for Argentina, because there was in April a deflation rate in Brazil of 0.4%, While in Argentina, we don't know the numbers yet, but there should be a high inflation.
Yes.
So in the case of Argentina, the devaluation of the peso does not mean very large competitiveness, but in the case of Brazil, that's really noticeable.
Yes, and I think one other point that makes this really important for the listener is that when what you just talked about, the investment funds understand that because they understand that the exchange rates are going to drive commodity prices. And that's why they will spread off one commodity at one exchange against another commodity at another exchange, because they do that with treasuries all the time. And with bonds, they do that with all the time. That it's called the yield trade, or the trying to go for yield. And so when we have all these countries trying to cut interest rates, that weakens their currency typically, and the emerging markets especially, it really cuts their currencies lower versus the US dollar. And so for the commodities, that's the short side of the spread essentially.
Yeah, and the Brazilian Central Bank already indicated that they would lower the interest rate again in the next time they should gather.
Yes, and we're talking about going negative in interest rates, and I think that would be a terrible idea, because I think that would be actually more deflationary. So in the emerging market currencies, the United States is key. The key I think is what the trade considers what they call a race to the bottom, where all the central banks cut interest rates to prop up their exports, and the dollar just gets bought more, so it makes the U.S. even more uncompetitive.
Yeah, and what do you expect about the U.S. trade with China? Because they committed to buy a lot more of the U.S. products, but at the same time, it's a lot beneficial for them to buy more from Brazil.
Yeah, I think that the buying pattern sourcing from Brazil is going to be coming to an end probably within the next 30 days. COFCO announced this week, and some other Chinese leaders announced this week, that they had already made plans to partition out a window of purchases from the U.S. and sourcing from the U.S. And COFCO has said that, and this was the vice manager of COFCO in China, has said that they will work towards meeting the phase one trade deal. I think you have to assume that soybeans are going to be a big part of that if they're going to come close to meeting that 40 or $50 billion number.
And what about the effects of all of these for the livestock market? Because at least they will have cheaper inputs.
Yes, that's right. And the USDA gave us large production numbers for 2021, 2020 and 2021. So it looks like we still will have a large feed sector. We still have a major problem up here, Luis, because of the processing issue. And I'll just give you two quick numbers. The current price of cash hogs right now is down 54% from last year, but the pork cutout, the actual cutout piece of pork that we utilize a lot of, is up 33%. Same with cash cattle. We're down about 13% versus a year ago, but our boxed beef that we make hamburger out of, it's up 100% versus a year ago. You're hurting that supply chain on both ends. You're not able to kill the animal to get it to through the processor to get it to the retailer, and therefore the prices are going high at the retail level, and people are shunning and turning away from meat now if they can buy an alternative. And this is going to be a global issue if this COVID rears its head again and we can't get this processing capacity back to a normal level. The Wall Street Journal talked about this just this week. I was really glad to see, a larger group of media talking about how there are serious issues with famine and food shortages around the world, because these countries that import all their food, they can't afford to compete with countries like Brazil and the United States, the domestic consumers. So we will be able to afford that meat, whereas a Central African country will not. And there will be famine this year. if we can't get this this rectified and get this COVID under control at this point.
And what's your recommendation for both grain farmers and livestock farmers?
I still want a rally to sell. As I told you before we went on air, I'm keeping my hands in my pocket right now. I'm not a long in the market and I'm not a short in the market when it comes to my hedgers. I think that we really want to watch the soy meal market next week. I think that technically and fundamentally, we're opening the door up to maybe some upside potential in prices at the mercantile exchange. And so a meal-led rally is usually a demand-led rally, and that would be really nice to see right now in light of the USDA numbers coming in and cutting the Brazilian soybean forecast.
Mike, always great to talk with you. Have a great week.
It always goes too fast. Thank you for having me, Luis.